All right, this is going to be a really fun rant about MicroStrategy Bitcoin volatility, the VIX, SPAXS, and warrants. And I know that seems to be a lot to cover, but all of those points all converge into this grand unifying theory that I have about the relationship between vol and liquidity, which is a crucial point to understand, especially if you trade options. Because the way that we think about options pricing, while technically correct, is the inappropriate framing of it all. So this all came up. We had a tweet from Investing Idiocy saying, please explain to me why shorting MicroStrategy and hedging with long Bitcoin is a bad idea, rather than a slam dunk that it appears to be with price to net asset value over 2. Okay, so the idea that he has is that he wants to look at the ratio between BTC relative to MicroStrategy's price action. Okay, so this is the relative performance of Bitcoin compared to MicroStrategy. We'll put it on a log. So it's really fallen apart here. And theoretically, he is correct. MicroStrategy has a certain amount of Bitcoin. They've issued a lot of convertibles, which introduces some leverage into the trade. And then you also have the MicroStrategy options chain, which has kind of been blown out a little bit, some gamma squeezes and some things going on there. And this should be just theoretically a slam dunk convergence trade where you can short MicroStrategy and get long BTC. Sometimes ARBs don't work because there is not enough liquidity to cause the convergence, and there is a secondary thing that is in motion, specifically momentum, that can cause this to completely blow out. So the second tweet I would like to reference is from Chris, who's a very smart options guy, talking about how sometimes you'll see this where, for example, 3-month at the money Pepsi vol versus 3-month at the money Coke vol, sometimes we'll trade a little bit differently. And then you look at the statistics and say, oh, this is a really weird thing. We can just trade the convergence on it. And then the trade gets blown out further because there are not enough people with the liquidity to bring supply that causes a convergence. And there are secondary things going on, specifically momentum, that break the trade. There's also one more trade that's trying to play out where you have people shorting MicroStrategy calls and buying decentralized finance Bitcoin derivatives, where you can go on to, like I think Thalex, we'll just give them a shout out. You can go on to that. You can buy some out of the money vol on those calls, and you can also short out of the money calls on MicroStrategy because the volatility differential, even when you include the leverage baked into MicroStrategy, is so freaking wide that it is a slam dunk. But I want you to actually think about the mechanics of that trade. First off, you're going to be buying crypto on-chain derivatives, which are not going to be linked to any kind of TradFi liquidity access. So you're not only buying a bunch of Bitcoin and crypto calls, you also have to go to MicroStrategy, which is, post-split a $371 stock, and you've got to sell a bunch of naked short calls on that. And there were people that did try and do that early, and they got blown out. Implied volatility continued to explode because there is not enough liquidity to cause the convergence, and there are other things driving movement, specifically momentum, that does not allow that convergence to happen. So right now I'm a big fan of Ionic IonQ, and this is a SPAC. This is a special purpose acquisition company spinout. And these were really, really big in 2020 and 2021 because with all the fresh capital that showed up into the markets, there was a lot of demand for stocks and not a lot of supply. So to get access to the markets faster and cheaper, and with a little sketchy thing that kind of happens on the side, you can get a shell company, fund it, and then do a reverse merger with that capital, and you can bring companies online. All right, so a really good example is something like Lucid, where Lucid had this poor stock. it didn't have an IPO. It was CCIV, which was a SPAC. And I know it sounds like I'm going off the rails. Just hold on for a second. This is all going to come back. It was trading at 10 bucks, and then there was an anticipation that it was going to sign a definitive agreement with Lucid Motors, caused a spike up to 60 bucks. After the DA was signed, it crashed again. But during that squeeze, you had a lot of things in 2021 that completely broke. Okay, and one of them was a SPAC warrant arb. So along with the equity offering that you would get with a special purpose acquisition company, you also had warrants, which kind of behave like a call option. It's the right to buy, okay? And these warrants should trade at the same kind of variation relative to the stock, but because there were so many retail traders jamming up stocks like this, there was... the equity just jammed higher. And then the warrants didn't move very much. So what you could do theoretically was short the equity and then buy some warrants, and then you exercise the warrants, and then you cover the short and you make the ARB. All right. So the warrant ARB idea has been around for a very long time. And it's a good idea in theory, but unless there is enough liquidity to cause the convergence, you can get blown out, which is what happened to a lot of people who were trying to pairs trade the equity and the warrants. Okay? So we can go and we can look at the VIX, for example. And the VIX is a statistical calculation based off of the S&P 500 market, options market, on a 30-day basis. And, there's some fancy stuff that goes along with it. But one of the things you can do is you can look at the VIX, which has a reading of 14. And this gives you an annualized volatility reading. All right. So the options market on a 30-day window is pricing in about a 14% rally or a 14% sell-off within the next year. Okay. Whether or not that happens, it doesn't matter. That's just what the reading is based off of the supply and demand in the VIX. Okay, you can also break it down. You can divide it by the square root of 252, and then you can get an expected average daily reading as well. Everyone still with me? A lot of people think about the VIX as it pertains to volatility and that percentage reading. And while that is technically correct, that is not what the options market is actually pricing in. You always have this strange loop when you think about implied volatility, where the volatility is implied in the options, but that option premium is just based on the supply and demand in the options market. So it's not about volatility, it's about liquidity. All right? The options market, think about the market makers. If the equity has a very wide bid-ask spread, it's going to bleed into the options market as well. And that would normally start to converge, but unless there is enough liquidity on the supply side to cause that convergence, volatility can just blow out. And that's what happens a lot when you see these vol blowouts in the market where, the VIX will go up and then it'll go down, and then it goes up and then it goes down. And then that third time you get something weird that happens, some kind of exogenous event or whatever. And that causes a volatility blowout because, yes, there were people trying to sell vol and looking for that convergence, but then momentum happened and you get blown out. So how does this matter to retail traders, for example? This is where technical analysis works. It's not technical analysis, it's liquidity analysis. If you're expecting a fast move away from a specific price, then the options market tends to undervalue that. Because the options market assumes that not the volatility, the liquidity at this current point in time is going to be persistent every single day. All right, so if you think price will move, then the liquidity is going to disappear. Price only moves if there is more demand for liquidity than supply. The convergence stops happening. Okay, and then you can buy some calls and then you can make lots of money off of that. That's why we do technical analysis, right? The same thing can happen. We're seeing a stock getting absolutely truck stick to the downside. There's no bid in sight. The options premiums are skyrocketing through the roof. What does that mean? There's no liquidity. And once you see an introduction of liquidity, then the options market starts to normalize as well. Okay? So the whole grand unifying theory for me, now that I've done this rant and I'm completely out of steam, is that when you think about options trading and timing the market and using charts, take a liquidity-based approach. It's not about, I expect the market to move 20% in a year versus 14%. It's not about that percentage reading. That is just an after effect of the actual thing that's happening underneath the surface. So for example, you go to January options expiration, a lot of leaps, long-term options roll off the books. And all of a sudden, the liquidity dynamics shift, which is why we often see a pivot either to the upside or downside after January options expiration. All right? Doesn't that make a whole lot of sense than just saying seasonality, right? You're not buying support on a stock. You're not selling resistance. You're looking at the liquidity turning points. And this is why options work exceptionally well with directional trading. Okay, so the reason we're not shorting MicroStrategy and buying Bitcoin is because it's really hard to do. There's not enough liquidity, and odds are you're going to get truck sticked by it. It's just a really, really hard trade to put on. Because I've looked at it, it's tough. There's too much margin, there's too much risk. We might be on the other side of it, where once you see the convergence start, you can actually start to express some ideas in the market, but it's just tough. And hopefully that lesson has bled over into that massive rant that I just did. And I hope you got something out of it. Enjoy your day.